Well, storage is abundant. It's just there's not many people, like I said, that live in the space because it's a capital intensive game.
It is.
But you sell them off, there's always a buyer for storage.
Always. That's when we fill up.
You have stabilized storage? You willing to sell?
Yep.
Yeah, we are. And we have 100 million of it.
Yeah,
we'll pay you a premium. All right, welcome back to Unfollow the Herd podcast, where we try to become the 1%. And if you can't, you should be listening to this because you can get on your path to get there. Today, I have a guest that is going to be a billionaire, even a trillionaire. May seem a little crazy. He's 31 years old, though, and he's got a holdings company, so a unique model. He's been on the show before. He's even progressed through where he's at was when he was here before, about a year ago, maybe a year and a half. I don't really remember, but Andrew Abernathey, I appreciate you coming back. He's in North Dakota. He's from North Dakota, so I always enjoy having him on. Thanks, Andrew.
Appreciate it. I'm excited for today.
Yeah, hell yeah, man. Appreciate you for coming up and coming over to, well, where are you at? Lake 𝗏𝗏goshi?
Yeah, Lake 𝗏𝗏goshi for the weekend.
Yeah.
It's a special place. Grew up in that area, so I always love going back.
How far were you from 𝗏𝗏goshi?
I grew up, farm was 40 minutes from it, so my great-grandpa's been going there since the 50s, my parents, and I just grew up on that lake.
Right.
Love it.
Simple farm kid.
That's right.
Should have took over the farm.
That's right.
How did you, I want to know, I'm just curious, how did you find, because I'm not really sure on the farm.
Yep.
Were you in the country, like literally on the farm?
On the farm. Six siblings.
What got you interested? Because you were at a very young age, started this investing career of you were living there. And I think a lot of people listening to this are like, okay, I want to start and I'm 40.
Yep.
I don't know how to do it. And you were, I don't know how old, maybe go into the story of that a little bit.
Yeah. So I was, at 10 years old, my parents knew that I had an interest in numbers and deal making. So, I was selling stuff to my siblings, from one sibling to the other in the house at 9, and Dad had me, doing some puts and calls in the grain that we had on the farm when I was really young, running combine, grain cart, working at the John Deere dealership. Was out in Delaware in the summers working at a Chinese restaurant when I was 13, 14, just anything I could do to make money. And then all that money I was using to invest in the stock market at 14 when it crashed. So really at the end of the day, I just...
In 2014?
No, that was 2009. I was 14.
Oh, you were 14 years old. Okay, gotcha.
Yeah, I was 14. I was 15.
Right after the financial crisis, you're like, all right.
Good timing. Yeah. Threw $4,000 in. That went well. Then I started getting into real estate because I farmed. My brother and I took the farm over in 2010 when I was in 10th grade.
Oh, wow.
And I didn't go full-time into Abernathey Holdings until 2014. It was actually just a hobby. I was going to be a farmer, and I was going to have holdings as a side gig. And then in 14, it was big enough to be the gig. So my brother and I, I'm still a proud partner in the farm, but I'm not active in any way when it comes to operations. So.
Wow, that is super cool. So how much, you started with the 4,000, that was 2009, you threw 4,000 in, you turned that, when did Abernathey Holdings, and we'll maybe go into more what a holdings company is.
Yeah.
When did you know that was the thing then and not farming?
Holdings was always going to be there, and the $4,000. So I owned 100% of Holdings. Okay. Put the $4,000 in. The $4,000 I turned to 80,000 by the time I was about 15, 16. And then I went and looked at some real estate, and there were some apartments in Bismarck that were about 1.2 million. My 80,000 wasn't enough.
How old were you at this point?
15, 16. That was
1.2 million.
And I didn't have enough. 80,000 wasn't enough. And I didn't have a balance sheet.
So did you even have credit?
No.
Zero credit.
So I went to the bank and they're like, we're not going to give you a loan. I'm like, shit. So I had to go and that's when I started raising money. So Abernathey Holdings, I went and raised my first, I think it was like 350,000 was my first round, just what I needed for the apartments. That diluted me down in Holdings some. And then that deal went really well. This oil boom hit, the city bought them like 15 months later for $2 million. And that's when I was like, all right, this is great. So that made me a millionaire before I graduated high school, that deal and a couple others. Wow. And then that's when I went and raised my first 10 million from farmers when I was about a senior in Holdings. Again, I just kept raising in the same entity. It's basically a private Berkshire Hathaway is the model. I'm a big Warren Buffett fan.
Yeah.
So
yeah, I know you are. And good Warren had to step down, but he's still he's still wealthy. Yeah, I know that. And so when you do that, let's just maybe talk about the holdings company real quick. When you sell shares, you dilute yourself down. You're doing an offering. Explain maybe the simplicity of the model.
Yeah. So Abernathey Holdings owns everything that I've had and will have. Outside of the farm, I don't do anything outside of Holdings. So currently we have 3 divisions. We have our equipment dealerships, we have our self-storage division, and our mobile home park divisions, which we'll dive into a little later here.
Yeah.
Holdings to date has had $65 million raised. I've raised $65 million in holdings, and that has diluted me down. I'm at 30% now.
Okay.
So I own 30% of holdings. I sold basically 70% of the company for $65 million over 9 various offerings over a decade plus.
Got it.
At different prices. Yeah.
Got it. It's an interesting model. It's just much different than normal syndication. Probably some of the listeners listening to this are used to syndications. I do those as well. It's just one deal per deal. But this is where you're bulking together your dealerships, your mobile home parks, your storage units, and all of your things into one asset sheet. I've asked many questions to Andrew on many long Zoom calls, and he, I think, went right over my head at least 6 times before I understood what he was talking about.
Yeah, it's once you live it like I have for so long, it's second nature. But I can see from the outside looking in where it's at the end of the day, Abernathey Holdings is basically a general partner, and I allow people to join me as a general partner. Okay. Because there's no carry, there's no fees, and we have JV partners. So we bring JV partners into properties that pay Abernathey Holdings developer fee, GC fees. So you're getting general partner returns. Okay. And that is why our shares nowadays sell at a multiple of book, because they are getting the upside of all the fees that a GP usually gets. So that's the uniqueness, is I've allowed 115 people to date join me as a GP passively. Got it. And this is a true passive investment. Yeah. Different with holdings is, and I think Berkshire Hathaway, it's not like you have a 8% preferred dividend that comes out of that. Never done a dividend. Our shares have gone from 8 to 80, and we couldn't have done that with doing dividends, right? It's like, I think, Berkshire Hathaway is worth about $1 trillion now. If they would have done dividends, they'd be worth not even $1 billion. That's what compounding returns is impressive. Right. And when you start pulling cash out of a business, so permanent capital vehicle and a long timeline are the 2 most important things to creating $1 trillion company. And those are the 2 things that I've created on a private level. Yeah. Time and cash. Permanent capital. Yeah. Right. Got it. Okay. I got to step back into this because now I think we might have shot over some heads there, including mine. When you bought this apartment, you were in the holdings company. I'm thinking about what maybe the listeners thinking about is like, okay, you were 15, you bought these apartments and you did well on them. You didn't know that at the time. You just knew it was an opportunity or saw an opportunity. Yeah. You probably didn't know. I mean, you must have penciled it somehow. Yeah. And it cash flowed the debt, and Bismarck had a pattern. In the 80s, Bismarck inflated the real estate values after Minot and Williston. And in 2009, 10, the same pattern happened. Williston prices were inflated because the oil boom came back. Minot was 90%, and Bismarck was hitting there like nothing's happening. Right. So that was my working theory at the time as a not so smart 15-year-old. A lot of this was pretty lucky at the start. I obviously got smarter. I'm still getting smarter every day. Yeah. But back in the day, there wasn't much. Yeah. So when you went to the banker, did he think you were crazy? Heck yeah, he did. He said, Andrew, I'm not giving you a loan like you're 15
just and tell him I need 800.
He's like, pretty impressed. You got 80 grand, but you need way more. You need way more down, and a balance sheet would be nice. What's a balance sheet? What's that? Okay. So if he can get a loan, and this is after the financial crisis, which is interesting to me because the banks were super loose in 2007, 8, no, probably not even 8, but 7, 6, and 7. Yep. To lead up to the financial crisis, all this bad debt happens, and then you got a loan in 2009. A small bank. It's a little regional bank in Mulhall that I'm from. So it wasn't a big bank. Yeah. And you had to find somebody to help co-sign on this. Correct. Yeah, that was the deal with the investor. They had to put in the money and PG it. Okay. And so you gave up some returns because of that, I'm sure. So it was pro rata. I put in my 80, he put in his 300. We both put our PGs on it. And I said the first money out could be my 80 and I'll work for free. Oh. But there was no PG fee, purchase guarantee fee. Got it. The hard thing though is, and I don't want to jump forward, but I think this is interesting. I went out in my senior year and I was in Fargo and I went to get a loan for another big property. And they're like, you have no credit. I'm like, what do you mean I have no credit? I had a $1 million loan. I had a PG on, paid it off. And they're like, apparently this small little bank didn't report to the credit bureau. So I had 7 years of business history in high school that didn't even exist. So I had to start over. That was interesting to me. So this small bank was your banker. Like you banked there when you were
10 to
all my deals.
15 to 18.
I knew, like, my buddy's dad was a banker, so
yeah.
What's up? See you
Well,
this weekend at your house.
Yeah, right. Yeah,
Playing basketball with your son.
that's crazy, and he didn't even report any of it.
Yeah, I mean,
So you had zero credit.
This bank, yeah, they don't report to the credit bureau. I was like shocked.
I had a credit line when I was 14. My dad was like $1,000 or something,
Yeah.
you know. It's like, and he's like, just make sure you use it, pay it off build some credit.
Yeah.
And I'm thankful that he did that, because I did have some credit at like 17, 18, where most kids don't have anything,
Yeah.
but shit, you still didn't have anything and you were borrowing all sorts of money. So it proves that, do you need to have credit? Probably not. I mean, as long as you know
Structure the
somebody
deal. Yeah.
that does, you might have to give up a little bit. You might have to put in sweat equity like he did.
Yep.
I mean, it's possible, because I think a lot of people, it's just like they look at where a beginning is and then they think, okay, a 15-year-old bought a 1.2 million. It's not. You probably underwrote it in about 12 minutes.
Yep. Yeah, I was custom combining, because we used to rent my parents' equipment, haul it to South Dakota, make a little extra cash between harvest and springs work. And I was coming through Bismarck and saw them. And I also want to say, like, it wasn't the first person I went to is like, yeah, here's $300,000.
Right.
Like, this was, I mean, I was knocking on doors sweating, because I learned the 80 grand I put down in earnest money was non-refundable. So I was going to back out of the deal when the banker said no loan. But I went to find out that I couldn't get my money back. So then it was I have to find an investor. It's not I want to. It was I'm going to lose my net worth if I don't find myself an investor.
That's the key then.
Yeah.
That's the situation you have to put yourself in,
make sure I
because
have
then
that.
it's like, shit, I got to roll,
No
or
choice.
it's gone.
Yep.
Everything I saved up since 10 or whenever you started.
Everything I have.
8. Yeah. Oh man. Put yourself in those situations. Then you really start knocking doors. That's pretty cool. That's actually a great story. So tell me a little bit. Okay, we got through your what holdings is. We got 3 entities within that. What's your dealerships do? What is that like? What's owning that today?
Yeah, so Normand Equipment was actually the first acquisition of holdings, an operating company acquisition. So I bought that when I was 20. So they started in 1947. They sell equipment to municipalities. In operating companies, I look for companies with high returns on total tangible assets. The average operating company in America makes about 12 to 13% return on tangible assets. So I look for things that are 20 to 25% plus. And the reason I do that is, I've gone back, we've talked about this last time, the Habsburgs and the British and the Dutch. We're at the end of a long-term and a short-term debt cycle. And usually what you're going to have, the only way to get out of this is to have higher inflation over the next 50 years. And so I'm looking at things like high return on asset companies, affordable housing or storage, which we'll get into.
Yep.
So anyways, saw this business. They were doing 20+% return on tangible assets. And we bought it. They seller financed 2/3, which was great.
Nice.
Because I only had $1 million raised of the 10 at the time during this quick period.
Okay.
And the receivables were short. It was all cities, states, and counties. And everything was kind of, you buy it, then we order it and deliver it. So you weren't sitting on a bunch of assets. So fast forward, we bought it. They were doing $3 million revenue. This last year they did 15 and a quarter.
Wow.
And then they also supply all the equipment to our construction sites. So a lot of our operating companies do work together at some sort. So vertical integration is a big thing we have across our subsidiaries.
How old were you when you bought that? I'm just trying to build
20,
a timeline.
yeah, 20.
20.
Yeah.
Bought a dealership. All right.
Yeah, that was out in Montana. So I've never been to Montana. I'm like, hey, Mom and Dad, I'm heading out to Montana. I'll see you. Not sure when. Dating some sketchy hotel. 5 locks on it.
So how did you find out about the deal?
Called every broker in the Midwest when I was 19 and said, I'm looking for businesses. And this one came across the desk.
Wow. Those are great returns. I suppose municipality, I mean, they got built-in clientele. It
was great. And
funded with budgets, right?
Forever.
Yeah.
And they seller finance 2/3 of it at a 20-year, 4% fixed interest rate. I'm still sending them 15 grand a month holdings as to this date.
Jeez. That's insane. No, that's awesome. There's many people that are trying to buy businesses and there's like nothing pencils today.
Yeah.
And that's probably true in most cases. Everything's flatlined from the COVID era. But okay, let's move into, when was your first storage deal done?
Storage deal.
Because you're developing 18. Or acquiring them?
We just went right into development. We did a lot of other real estate. So when I met my mentor, Gary 𝗨𝗲𝗍, and he told me in 17, I'm good at a lot of things, not great at anything. And that was my era. I was living in Fargo. We had a lot of stuff downtown, high-rise buildings, HUD buildings, office, retail, just nothing really rhymed.
Okay.
And so talked to him. He loved the storage idea. We sold everything off, and in 2018 went all into developing Class A self-storage. And our first project was in Arizona, actually.
Oh,
so I moved out there.
Gotcha.
In 2020.
2020, and you were...
But I started in 18.
27, 6?
Yeah, 26.
26?
Yep.
So that was their first, and then
okay,
where are you at today with that?
That's our biggest one. So we've got a $250 million pipeline. Last year we broke ground in 50 million. This year we got 100 million ground breaks. The goal is to get up to $500 million a year in ground breaks.
Okay.
That would be about 5% of the storage in the U.S. Like this year, we're building 10% of the new storage in Arizona. What would come from Abernathey Holdings. California, we just entered. Then I'd like to get in the Carolinas.
Okay.
So anyways, that's the goal. Storage takes, so what I loved from, and again, going back to Gary, he said, I'm not really in the hotel business, Andrew. I'm in the manufacturing business. I just so happen to manufacture hotels. All billionaires manufacture something. I don't look at real estate as, I have farmland that I'll never sell and I buy it and hold it, but that's separate. That's like a bond to me. It's a certain percentage of my portfolio. But when it comes to real estate, we develop it like a product. It takes 1 year to entitle it. It takes 1 year to build it with our own construction crew in-house.
Yeah.
It takes us 3 years to fill it. Once it fills, we put together $100+ million a portfolio to get a premium, and we sell them off to Public Storage or somebody else. And our IRRs are in that 20-ish%, give or take 5%. Usually about 25-ish, but call it 20. And that's the machine. If we don't sell them at stabilization, our IRR actually decreases because people to this day will pay a 5-some cap rate if there's a portfolio.
Yep. So
the secret in that company is if you want to build them for less, which we do by having our own GC in-house, equipment in-house, bulk ordering materials, we architect, all those things. So we build them for less. We fill them quicker because our team's done so many now. They know exactly the location, so it's a volume thing.
Yep.
And then we sell them for more because every year we're developing a portfolio that earns a premium.
Yep.
Anytime you can sell a portfolio of more than $100 million in properties, you get a premium. So that's how we build them for less, fill them quicker, and sell them for more.
Yep. So it's a 4 to 6 year process.
Yep. So you don't see a dollar. But in 2028 now, our first large portfolios will start to roll over in 28. And every year after that, we'll have a portfolio rolling over. We'll be pulling in $250 million plus a year in exits.
Right.
That'll be reinvested into that division and or sent back to me at Holdings to redeploy elsewhere.
Got it. We're kind of similar path. Just myself kind of obviously learned from you and on trying to work on the top end and just building assets that the wealthy will buy, or
Correct.
You're in a different market. I'm in the Midwest, so but I'm trying to build Class A larger storage facilities, fill them. But it's funny, I do talk to high net worth individuals, and it's funny, it's like they listen to the same podcast. It's like, we hold on to it 4 to 6 years, max out our IRR or ROI, you know, and we're out of it.
Yeah.
Let's roll into the next one. Let's max out the depreciation, max out the amount of money we're going to make, and we're going to flip it over.
Yep. Because in development, we develop in about 66% stabilized value. And that's where your wealth is made.
Okay.
And I like to swim where others aren't swimming. What I mean by that is going and developing a $20 million build. Each one of ours is about $20 million.
Yep.
Going and building a $20 million building, hoping it fills, and having the cash for 5 years of no money back, just deploying. Like, it's an arena that not everybody plays in. And I like to be where nobody else is.
Yeah.
It just seems to be a little easier.
Right. Well, storage is abundant. It's just there's not many people, like you said, that live in the space because it's a capital intensive game.
It is.
But you sell them off, there's always a buyer for storage.
Always. That's when we fill up.
You have stabilized storage? You willing to sell?
Yep.
Yeah, we are. And we have 100 million of it.
Yeah.
We'll pay you a premium.
Well, we're at the point now, so Public Storage runs our facilities. We're at the point now where we're opening markets for them. So Fresno, California has no public storages. And so we have $100 million of product that we're going to be building in that market. So we're going in and actually
Frisco?
Fresno.
Oh,
California.
Fresno. Okay.
So we're going into opening markets now for which is a really cool relationship to have with a $50 to $80 billion company.
Yeah.
I'm not sure what their market cap is right
now.
Oh
God, yeah, gigantic. Yeah. I mean, they manage everything. I thought it was interesting when you were building it that they were managing it for you, but that's probably all by.
It is. So we were the first one to sign up. So Marriott did this in the 70s. So Marriott owned all their hotels in the 70s. And then once they built their brand, they went to an asset light model to have the higher return on assets. Now they own 1% of their hotels. Gary was on that bandwagon early. So we were the first 50 to sign up with Public Storage. And I do believe in 30 to 40 years, it's going to be the same as Hilton and Marriott, which is public and extra space.
Right.
And we can sit there and say we were the ones that built out their third-party process, just like Gary did.
You were the first one that went with public.
We were like the
third party?
first 50, I think it was.
Okay.
Yep.
Gotcha. I didn't know how it worked with them. I know
That was in 17 it started, and we started like that year after talking
okay. That's super interesting. So, okay, that's where your storage is at. Where would your, I know you're doing mobile home parks, Brandon Turner, he's probably not listening to this, but I'll send it to him. And, cause you're buying all his mobile home parks, and
Yeah.
I thought it was interesting when you called me. He's like, I had a guy that I think I got more use from him doing this instead of what I had him doing. Maybe go into that, because I think it's kind of neat how you get into that. It's like, we got the dealerships, we got the storage, mobile home parks, whatever cash flow. The cash flow comes from mobile home parks.
It does. And before I go into it too, I want to mention, there's I don't know if you read The Hedgehog and the Fox. It's an old business book, but it's a good one to read.
Okay.
And basically the gist of it is, the hedgehog is more successful than the fox because it can just sit and focus on something, and the fox is just all over there. So you have a hedgehog process, basically.
Yep.
There's two types of hedgehog process. There's a process and there's a product. So what I mean by that is each of our subsidiaries have a hedgehog product. Our equipment dealership's not building storage, and our storage company's not building equipment. They have a product that they only do. That's all they focus on. That's it. So a hedgehog product. Holdings is different. Holdings has 3 employees out of all the employees, because everybody's in the subsidiaries. Holdings has a hedgehog process. Our process is looking for good businesses, good industries with high returns on tangible assets, led by good, honorable people. That's our process, which leads us into really random things, which we just said: equipment, storage, mobile homes. Who knows what else we'll be buying in the future? So circling back, mobile homes. So Dan, I'm going to do a shout out. Dan Gibson. He met him in 2020. He built his. He's from St. Louis. He was knocking on doors as a 20-year-old, just doing seller financing, buying up mobile home parks from cats, smoking cigarette cat ladies. Collecting.
I bet you acquiring these is interesting.
Yeah, it was. He has a great story, and he was just buying these things up when they were 12, 15 cap, seller financing. Just. Anyways, in 2020, he had 1,000 some lots, and he wanted to double in size because he was just sick of being the guy. He's like, this is a lot. We need to double in size so I can hire someone to be the president. So he made an offer on a park or a portfolio the same as his. He said, offered like 15 or so million. And the broker said, hey, you got beat. He's like, what do you mean I got beat? He's like, somebody offered 31 million for that. He's like, are you kidding me? What's mine worth? Like, that's crazy. So this group bought his. And so he moved to Arizona, became, he's our 4th largest investor, joined our board, just a great guy.
Yeah.
He joined the land team. Kind of like young, retired a bit,
something
playing
to do.
Golf. Yeah. So anyways, then the real estate correction happened, and all these parks, these and some other ones, things changed. They weren't selling at 4 caps. They were 8, 9 caps again.
Okay.
And people are out of money. So Dan's like, hey, would you guys be open to doing this? We're like, hey, put together a plan. And so he put together a company called Ozark Communities. He's rolled up 13 parks already. We've split about 25 million.
Okay.
But he's known in the business. I mean, he was in it for so long. So he's got people calling him weekly. Hey, remember we talked 12 years ago? I'm ready to sell now. So Holdings now owns 100% of Ozark. Dan runs that. He's got his whole team out in St. Louis.
Okay.
And we're literally acquiring parks now across the Midwest. I mean, the goal is to, as much as he can. We basically gave him a blank check.
Just keep buying parks. Well, and you're acquiring these, like you said, the cap rates obviously are making sense today.
Oh yeah. I mean, we got a lot of start. Like the last year we spent 25 million. I think we only put down like 5.
Okay.
Because seller financing opportunities, bank loans, and then he can come in. We've got $7 million in mobile homes on order right now to fill 200 of our empty lots.
Oh, sure. And then rent them out. Yeah. Whatever.
So we own about 280 homes of the we have like 1,350 lots right now. We own 285 of the homes. Well, about these 200 more homes on order. So
that's interesting, because I'm sure that's an interesting tax play as well.
Just gonna bring that up. Yeah. So bonus depreciation is back, baby.
Yeah. 100%. Yeah. BBB.
Storage, we get about 30-ish% of the build. So 5 to 6 million is bonus depreciation.
Okay.
In mobile home parks, it's about 50%.
Yeah.
Now, it depends on how much is mobile home park, homes that they own and how many your tenant own. But that 25 million that we just did, I mean, there was over 10 million depreciation through our K1s to our investors. So we don't do cash dividends, but we do depreciation dividends, I like to say.
Right.
And those are valuable if you use them or can use them.
Gotcha. Yeah. It applies to their K1s, and then they can use them for whatever they're invested in. Gotcha. Wow. That's interesting. It's funny that all of a sudden he's back in the game and you're acquiring mobile home parks. You're in deep. Well, now you're
I'm trailer
all
trash
in
now, baby.
So if you have a mobile home deal, send it to Andrew.
Yeah, send it over.
We'll link something below so you can get a hold of him and send him a deal if you got one. What's your biggest problem right now?
Well, I think it's funny. I probably have more ideas than money, and hopefully someday I have more money than ideas. That's what Warren Buffett, you go through that transition as you get older. So we did an offering back in 21, and then we were 60% cash in holdings. And then then your bottleneck's people. So then you go and put the leaders in place and the people and the systems, and then you get that money deployed, or a good chunk of it. Now I'm back around to saying, okay, hey, man, these guys are, doing things quicker than I thought they could. They're crushing it. I'm not going to be the one that holds them back. So now we're going to go do another offering.
Okay.
So to answer your question, it's not a problem per se. It's just funny how your bottleneck goes from money to people, back to money to people, back and forth. Yeah. So that's the current one. I'm going to go and do another round just to make sure that these leaders never get held back by capital.
Right.
They have such great talents.
Right. Yeah. I think you've done a good job, or it's just, you've done it at a younger age where you've let other people lead, and you're not inking every deal. No,
there's not one company that I really run. I mean, I run holdings.
Yep.
My job is a capital allocator cheerleader, basically. I'm there for these guys. We talk all the time, but at the end of the day, it's their decisions. They run it as they wish.
Right.
I incentivize them like Berkshire does. So it's they get a bonus above a 20% return on assets. So holdings gets the first 20%. And then they get 10% of everything above that.
Okay.
And so what it does is I don't even have to watch them, because at the end of the day, they're not going to keep any retained earnings that they can't put to work at a good return, or they're going to dilute themselves. So I get money sent to me when they can't deploy it themselves, and I either deploy it in another entity or I find new opportunities. I think these current three divisions can get us to $1 billion. Right now we're at about a 200-some million valuation. I think they can deploy enough to get us to $1 billion. But after that, I mean, I'll need to make large acquisitions on a yearly basis from that point on. And so, is it this money raise that might be a big issue, or to keep these guys going to get to the billion? Because you're at weird glass ceilings, like you said. It's like you're 15, you're gonna raise you had that issue, and then you're at 20 and you acquired this dealership, which was probably another small issue. Yep.
And then you start storage at 26, and then a lot of capital gets deployed quickly.
I mean, we've got, I think, 20 million left, and I'm going to raise another 45, but I've already pre-sold. The offering isn't out yet, and I've already pre-sold, 15 million of it. So I think it's gotten easier to raise money.
Right.
Because now you've got 115 people that are like, I'll take what I can. They want it. So it's been really great. So I don't know if it's a problem, but that's my next thing. Like the next 10, 12 months, my goal is to just get that done. And then we can go back to scaling. I mean, the next bottleneck would be, okay, our team's doing 100 million in ground breaks right now. That's a lot. How do you get to $500 million? Like, that's a bottleneck. There's things, processes, procedures.
Oh, yeah. Well, operations. It goes back to capital. And then we're in the process now where we've started storage units, but we're operating them.
Yep.
So now we're moving management. Now we're trying to figure out how to market them, how to fill units effectively, how do, that public storage has that you're not worrying about. So there's a dynamic, just because we have kind of a unique unit style that's coming more popular now.
Yeah. Oh yeah.
But it's, that our biggest hurdles is, and then, we raise money deal per deal.
Yep.
So it's like, now we're doing a start every quarter. So now it's like, okay. And now we have two deals that literally, I was telling you before this, lined up exactly at the same time. It's like, shit, now instead of 3 million, we got to raise 5 or 6.
Yep.
So that stretches us, and then you get more creative though. When you get put in those pressures, because we put money that went hard.
Yep.
So now it's like, well, I don't want to lose.
This is what it is.
A couple $100,000. We're going to have to raise it.
Yep.
We got to figure it out. So I think that's just part of being an entrepreneur. You put yourself in weird situations and you get creative on getting out of them. But I think it's also cool that you've either figured out how to delegate and let go? Because there's many people, I would say most of the people listening to this that are running a coffee shop, a gym, even one hotel are gonna be like, well, I need to be able to, they need me there.
Yeah. And that's a hard thing. You know, I have got friends that have built big businesses, but when you build something, when you bootstrap it, the business is built around you and your identity. And so when you are ready to delegate, it's hard. It's hard to walk away. It's hard to separate yourself. I skipped that phase. Now there's pros and cons, right? People that are the face of the business and bootstrap it, they probably own 100% or 90%. For me, I only own 30%, but I raised a bunch of money, diluted myself. All the money I raised allowed me to skip the bootstrapping. I just had acquisitions, which meant I could skip right to the delegation stage, which means I've never had to actually step away from a business because I was never in it to start with.
Right.
So that's a luxury.
Yep.
But I only own 30% of everything. So pros and cons.
So, okay, let's just say the dealership, and maybe you found another dealership to buy.
Yeah.
You're looking at this business. There's a financial metrics that you're looking for.
Correct.
Is it only financial metrics, or you're going to go there and you're going to find the leaders, or you're going to find...
Well, that would be considered a bolt-on.
Okay.
So the nice thing is the leader there, for example, in the equipment dealerships, Luke Stewart would look for an acquisition. He'd bring it to me and say, I think this is great. Here's all the operational standpoint. Here's what I think I can do. Obviously, he's going to need to make more than 20% on assets, tangible assets, because... or else he will be hit personally financially, right? But the blue sky we pay is my decision. So I don't incentivize our guys, even on bolt-ons, on blue sky. That's why I do tangible hard assets. So I would come up with the value based on his numbers and his operational expertise and the numbers he gives me. I would then base the purchase price offer blue sky on that.
Okay.
So if that makes sense.
Yeah.
But I would use his numbers for
I think
that.
I get about 10% of it.
Yeah. So
usually that's what I get when I talk to you. But
yeah. I would take Luke's word for it.
Yeah. It does make sense. I mean, I think so the financial piece, I think, understand, are you looking for culture? Are you looking for what that business is built on? Are you diving any deeper into that? Because I'm just thinking if I go buy a business, right? Like, all right, hey, I want you to buy my lumberyard. Yeah. Okay, great. It does $5 million a year. Great. Or 20%, whatever. Okay. Yep. We're okay with this. We can vertically integrate it if I did in my building, you know, and I'm a contractor and locally, but it's only Tim and Tom running it. And everyone loves Tim and Tom, but Tim and Tom want to retire. Yeah.
You know, that's a good question. So if bolt-ons are a bit different because you're rolling them into an existing operation with existing people. And I lean on that president to take care of whatever he needs, because every division has their own morale and just different how they run things, which is fine. I support it. But if I'm looking for a new acquisition, for not a bolt-on, yes. I'm looking for a track record. I'm looking for a company that I'm not buying a job. So it's got to be a company that's got, now this has changed. I bought Normont without a president lined up, and that was a mistake. I got very lucky, and I met Luke, and I'm not going to roll that dice again. So my point is, going forward, all acquisitions need to come. I don't have a room full of managers sitting in my closet. Yeah. So going to need it set up, going to need track record. It needs to be at least 20 million plus for me now, because you go buy a $3 million business, that EBITDA is $300K. It's like, okay, I mean, you can't really afford that much talent to run this. It's kind of a job. Yeah. So I mean, I'm looking for larger acquisitions. Okay. But morale and culture and longevity and proof of concept. I mean, those are all the moat, competitive moat. And then I ask myself, if this business is 20 million, if I give some guy 20 million, could he build that same thing, and how fast would it take him? Yeah. Like what's proprietary? Think about that. Yeah. Yeah. I always think about when someone's trying to acquire a business or build a business, or I think we were talking about like Jack, like you said, like you don't want to buy yourself a job. Most people want to go into business to go get really big. I did it for 7 years. I just bought myself a job so I could work 5 to 9. Yep. And cause all this pain to myself when I didn't build a business. If I died, you sell the assets and you're done. Yeah, liquidate. There's no goodwill. Yeah. Well, then you get into this passive income. Jack brought up the question, one of our interns, and he's like, well,
what is passive income and how do you do that? And it's like, you can't just go acquire a fourplex and it's called it passive. It's not going to cash flow today.
No.
You can make money if you manage it, you clean it. Maybe you have one as a short-term rental. Maybe you live in one.
Yeah. Which is the way to go when you're starting, like do all those things.
Yes.
Probably. Yeah.
It's the only way you're going to make money on it though.
Yeah.
People are like still in the belief they're going to acquire a fourplex and retire when they're in 15 years with this.
Yeah. It takes time.
Yeah.
And you have to learn the financial aspect, I mean, not jumping, but there's a lot of, if you give me a balance sheet, a cash flow statement and a P&L, I can tell you a story of a business.
Yeah.
That's the diary of the business. And so, for example, this is just one thing I look at, but if you take, let's say the average gross profit margin in an industry you're looking at is 30%.
Yep.
And let's say the company you're looking at, everybody else is 30, and that's the one you're looking at is 44%. That right there is showing me that they have a competitive advantage. They have a product that they can charge a premium for, like Apple. Their gross profit margin's higher than other phone because they have a brand.
Yeah.
Right. That's what I look for when I buy companies. I look at the industry average I look at a lot of things, but that's an example.
Yeah.
What's the gross profit of the industry percentage? And is this company I'm looking at have a higher one? If it does, that tells me, without even going to the company, visiting, that they must have something they're selling that somebody's willing to pay more for. It's not a commodity.
Yeah.
That's interesting to me.
What, you send the financials to you, you're going to look at all these array of things. Where did you learn that from, or how, is this just over time or?
Yeah. I mean, I took Harvard classes online when I was like 15, like YouTube has them for free.
Okay.
You can I learned discounted cash flow on YouTube. It was like an hour-long clip from Harvard. Like, it's awesome. Like, you can find anything online.
Oh yeah.
So I've just
YouTube University.
I think one of my biggest, I've got a lot of faults like all of us do, but one of my talents is I'm just naturally curious.
Oh.
I'm always learning, and Audible books. I read a book once a month. Like, I'm always learning.
Yeah.
And when I'm curious about something, I just look into it.
Right.
So all these things are just like money compounds, so does knowledge.
Yeah.
And
yeah, I'd say being curious, that's one of the strengths of any entrepreneur.
It is.
Because we're probably almost too curious at times, and then we reel it back that we're like
shiny object.
Yeah. It's like, no, let's not do that. That's gonna, so let's go, where else are you headed? What's like a goal this year? What's a goal in 5 years?
Yeah. This year I'd like to get this year and next year I'm gonna get the offering done. I'm gonna the construction team for storage. I'm gonna let them hang out at 80 to 100 million year in ground breaks for a couple years, because there's a time to push the gas pedal and there's a time to just let the team, because there's a lot of systems and stuff. If you push too hard, it breaks.
Yeah.
So you can just feel that. So right now we're gonna hang out at that 80 to 100 million the next year or two. On that side, mobile home parks, I think he's going to slow down on the acquisitions. He's going to focus on his systems now and filling these lots. I mean, he grew from zero to that really quick. Equipment dealership, this year was the year we were focusing on systems. Now we're going to go on another growth phase.
Okay.
Look at another location. So that's the quick and dirty of the goals in the divisions. Get the money raised. Once we get this offering done, we'll be back to like 40% cash to book value.
Yep.
Our valuation will be around 280 to 300 million when this offering's done.
Okay.
So zoom out to 2030 to 34. I always like to talk broad, because to me, things are done in broad strokes. I don't look at micro economics. I'd like to hit that billion. I don't know if we're going to have a whole lot of acquisitions. My job might be might be hanging out for a good 5-6 years while the divisions get this money deployed. Yeah. Because they do it all. They're great. They're experts.
Yeah.
I am really excited when the day comes that they're going to be sending me so much money every year that I can make a new acquisition like Warren Buffett has to place like 100 million a day. Like, that sounds awesome. So I'm excited.
It almost sounds stressful. I can see why he just buys stocks, because it's like, how do you deploy?
Well, he's got 30% roughly of his market cap in cash right now.
Oh, I know.
How do you deploy it that fast?
So you can't even acquire enough business. Like, you can buy the whole stock and the whole business, right?
They'll have to eventually do just the law of numbers. They'll have to do dividends eventually. It's just you can't continue to redeploy it.
It's too much cash. They're going to wait till Warren.
Yeah, he's not going to want to see it.
Yeah, you're right. You're going to wait till something happens to Warren. Yeah, that's good problems to have, I guess.
Yeah, but yeah, so the billion's the number. And then the trillion number, where that comes from, is assuming I can live to 95. Our average return since 2012, we've done 20.68% compounding. If we can just do 15%, which I'm not saying is not a lot, it is, but if we can do 15% from here on out, at 95, it'll be $1 trillion company.
Dang.
So it's really, investing is not like 3D chess. Like, I don't have that high of an IQ. I was a straight C student, proud of it. And
oh, you too?
Yeah. So the point is, like, it's really just temperament, patience, just literally sitting there and just doing nothing most of the time. Like saying no to 99% of everything.
It is. I would agree with that, and I think as we've like gotten more opportunities with storage, it's like we learned to say no a lot more. I think you told me that like 2 years ago maybe, and it's like, you just got to say no. 2 right-hand turn, whatever. I remember we had this initial conversation.
Make your checkbox.
Yeah,
and it's just like there's no emotions.
But you got to say yes to a few bad ones in order to really dial in those good ones. And I've learned that now we have so many opportunities that we got to say no all the time. And right away it's like, we got to string into this certain deal in Florida, and it's like, I'm glad I didn't do that one.
Yep.
I'm always a believer that everything happens for a reason. So, and you get put in situations because you made them. Yep. And real quick, I'm gonna do a spin on you. 95 years old. I seen that you wrote that down. You're gonna be a trillion or have $1 trillion company.
Yeah, which I'll probably, because we'll do some buybacks. I'll probably own about 45% of it. So 450. Okay. But in today's dollars, that's about 100 billion with inflation at 2.5%.
So how do you know you're gonna live to 95?
I got 3 grandparents in their mid 90s. So odds are there. So take care of this, tempt the body.
Well, in the Midwest, we drink, we eat bacon, and drink a lot of coffee.
Yeah, it must work because they're all good old purebred Norwegians, and they're still living.
Oh yeah.
But I'm trying to be. So I have the 5 F's. Fitness, family, finance, faith. I don't know how many friends, whatever I missed there. The point though is, fitness was one that was like 0 at 29. I just had no. I didn't go to the gym in my 20s. And so 29, I stepped it up. I mean, I eat 80% now clean. I work out 3 to 4 days a week, have a trainer. I went from 23% body fat down to 13. So I'm really taking fitness a lot more serious in health lately. And it's
cool, interesting to talk to health, and people are so interested. It's like you got these peptides now, you got anti-aging, you got red light therapy. You don't have to talk about it if you don't want to. But like, what's your routine? How many times a week are you going? And what kind are you on vitamins doing?
So I have a home gym I do during the week. So, and then the gym on the weekends. But I try to go 4 times, give or take 1, and then eat. Like I said, 80% of the time I'm trying to stay at 50 grams of fat or less a day, 200 grams of protein. I always try to get my protein in. Even at the lake, I'm just like pounding protein drinks. The fat number did not get met, but the protein I got in. And I'm in testosterone. I had stress and those things. I got 3 amazing boys. I had a busy 20s and the company. And so my testosterone, when I tested it like a year ago, was like 300 or something, which is really low for my age. So I'm on that now. It's 1,200. Yep. 1,012. And then I'm actually going to start some peptides here now too. And I'm really getting into all that stuff.
Yeah. There's a lot of people, I've done hair plugs, you name it. I've done something to try to help
Technology's
myself. Technology's there. Yeah. I try to use it. The peptides are interesting. I'm not on TRT, but again, I was in like the 500s, 600s. Yeah. I've always lifted a lot though. And I've always worked out through my 20s, through my 30s.
That helps raise it.
Yeah. And so, but I had peptides. I'm not on TRT. I've just done peptides to help get it to 1,000. And I've been pretty good with that.
Yeah. I think I can lower my TRT once I start these peptides. I'm actually just getting into it now. I got a clinic deal a week from now. So hopefully
you're in Scottsdale. You have options down there.
So many options. Too many options.
Yeah, right. Yeah. Oh, yeah. Down there, you can get lost, and you could probably spend $1,000 a day on your health.
Yeah, you can. So I got to keep that in check. I mean, you need to know who you are when you move to Scottsdale.
Yeah. I love visiting that area, but it's probably funny. You were from the Midwest, farm boy.
I still drive a pickup down there.
5 years ago, you moved down there now, almost.
It's crazy.
I mean, so you've been down there. Kind of a culture shock a little bit. It's fun.
Yep. It's fun.
Winters are really nice.
Yep.
But yeah, the difference is you come up here, you probably come home and it's like everyone's drinking. It's Midwest. We're making hot dishes and
but it's good. It's beautiful.
Eating chips all day.
Life's all about balance. It reminds me of why I like to eat healthy. It's crazy how you feel.
Oh yeah.
The difference.
Yes.
But I think there's a balance, and I do think you will be who you hang out with. So like in Arizona, I've got a really good groups of people that are people that I want to be like. I don't think you will be the average of who you hang out with. I think you will be the lowest of in your group, the lowest person that'll be who you are. Like, so I really take that into consideration when I'm socializing, because I think that's a big thing. Well, wherever you are.
Who do you hang out with in North Dakota? Let's just say it's rural. There's not a lot of people. There's probably 50 in the state that are like talking in the terms maybe you are and wanting to do big things. There's maybe more. I'm just consolidating that, but it's not many. How has that changed? I always find it interesting when I go to Scottsdale and who I meet there.
Yeah. I mean, 70% are people, they're credit millionaires where everything's loaned and fake and it's not real.
Oh, really? Okay.
Yeah, you got to sniff that out. But
sniff that out.
Yeah. No, there's great people. I mean, the nice thing is you have so many options for different groups. I don't watch sports. I never really have. So this is actually really funny. My family and I laugh at this, but I've really become friends with a lot of like Cardinals players and Giants baseball players and like retired athletes that are like not my age. And I don't know who they are and I don't care. They're like, I don't watch, I don't even know anything about it, but we've really become good friends because we can relate on, they did a lot of things at a young age and now they're trying to get into business because now everything they put their whole life into is over. Yeah. So we really have a lot of fun together and we've enjoyed it. So that's been kind of my new circle for the most part. And then just other business owners and like this one guy's from Philadelphia and he does the billboard, the law stuff. And he's just built this crazy business. Yeah. Awesome business. And he's just a really cool dude.
But he's a good marketer.
Yeah. And he's just like grounded. You could just seek those people out. Yeah. And it's just, I got a really good crew there.
Yeah. Yeah. What's some of their biggest challenges then in Scott? It's funny. I mean, just some of these, let's just talk about these ball players because I think would be challenging. Retiring at 30 and that's all is ball.
Yes. I've learned a lot from them. Like, you have a lot of guys that they offer a deal where you get like $200,000 a year or whatever, but you can't make any money. So they basically just are forced into depression. I mean, I think like 70% or some of them go bankrupt after so many years. Yeah. So you got these handful of guys that want to make something with their life. They want to do something. And they're coming out of something they spent their whole life doing. And then they come to guys like me, which is an honor. And they're just like, I just want to learn. They're curious and they're just as driven in learning about business as they were about the sport. Yeah. So it's just really cool and fun. And they're just, when you go and drive around and see sites, they actually like take it and apply it to something. Like they're just really driven people. I enjoy that. That's what people are looking for. Like when you give, like Gary Thoroldson, like he's told 100 people his stories, hundreds of people, but it's because I went and did something with it that he, put his arm and took me under his wing. And that's what you need is something to actually go do what you're told. Right.
Yeah. I was going to say exactly what you said. They're driven people. Some NFL guys I've talked to and invested and guys just on a mission. Yeah. But they've got to buy businesses. They got to do something. He's like, I don't know what I'm doing. Yep. But I'm gonna do it. They got some capital when they come out. Yeah. The problem is it's burning. Yep. And they don't know how to invest it properly. I don't know what the NFL does. I've never really asked them. It doesn't. There's different pension programs or something they put them on, but it's like not enough to live their lifestyle when they're playing ball.
Yeah, and then the difference too, like I got a friend that plays Giants, and there's the football guys. The football ones, they're not guaranteed contracts, so like they're just living in stress all the time. Baseball is interesting. You sign a $200 million deal, and you get injured the next day, you get the whole thing. Oh, it's guaranteed. Interesting. So it's just, I didn't know. But they play like 180 games a year.
Oh yeah, stupid.
And football friends play like whatever 30, whatever. It's like I don't watch sports. I'm like that's things I'm learning. It's just kind of funny.
I have no idea, but
I have really no idea, but it's really funny.
That's awesome. Yeah, that's people you're gonna find in Scottsdale though.
Yeah, you will. You'll find anywhere from the guy that rents a Lamborghini for a date to guys that drive a normal car but they're worth $400 million and they're 35, 38. I mean, you get it all.
It's insane. So what's Holdings? I always just get curious about this Holdings, and I think I want to wrap this up with how people understand it. How do they get a hold of you, and how do you get a hold of new people and talk about investing? Because you're not like I ain't find you on the stock market, right? Yeah, no. Yeah. I got to talk to Andrew.
Yeah. I've been in the middle. I mean, it's all accredited, of course, investors, qualified, credited. And it's been just kind of a word of mouth. We have 115 investors, partners. I like to call them family partners. Yeah. It started out where it was just farmers, in my area, and then that farmer knew somebody, and then I went to Fargo and met new people, and we have got investors now in a lot. I didn't know how many states now. They're all over, but it's all just warm referrals. It's just flying in and like, yeah, I like this. Here's $250,000 or $1 million or maybe 50 to 60 grand to start, whatever it might be.
Right.
So yeah, I just love talking business. I vet partners, investors, like they vet us. I mean, I'm looking for someone that I would want to be a partner with.
Right.
It just takes one bad apple. We have a unique model. It's a wealth building, long-term thinking, patient money vehicle. It's permanent capital. It's, we're not someone you put money into and expect a 100% return the next year. I mean,
right.
I'm shooting for 15%. Yeah, we've beat it, but as long as we can average 15% over decades, my money and your money should be in there. And I said, if it doesn't, then I should take my money out as well.
Yeah.
So
I always find the challenge too with like investors, they're so short-term thinking right now.
Yeah.
You got these traders and crypto and it's up, it's down, it's left, it's right. And with yours, it's like, I tell people like when they invest in real estate, it's like, just let it go.
Yep.
Don't worry about it. And that's what I love about it. And I hate stocks and crypto because it's up today, it's down tomorrow. And you're watching it along the way. But it's the hardest investors to understand. Should they be investing long term and just think, hey, I'm investing now. What is it going to be in 10 years?
Yep.
That's how they should be thinking. But a lot of people don't. I mean, and some of the difficulty.
Yeah, and that's where the currency part we touched base on a bit. Like there's investing and there's speculating. I'm an investor. I'm not a speculator.
Right.
Any currency, I don't care if it's Bitcoin, the dollar, the yen, all currency, if you're buying currency it's not an investment. It's literally a storehold of value between acquisitions. That's what it was made for. Mm-hmm. Whether I'm buying and selling businesses in seashells or Bitcoin or dollars in 50 years, it's relevant to me. So buying a currency, even gold, I don't believe in buying gold. If you put all the gold in the world together, it'd be a 68-foot cube. And it'd be worth like $7 or $8 trillion. So you could, if I gave you $8 trillion, you could either buy all the gold in the world, put it in your backyard, get hump it, kiss it, do everything with it. It's not going to do anything for you. Or you could buy all the farmland in the world, 3 Exxon Mobils, and have $1 trillion walk around money. And so I always think to myself, if the market shuts down, if nobody will buy anything I own from me for 100 years, will it still be good? And the answer is you need to have income producing assets, the farm, rental on storage, operating companies, gold, Bitcoin, the dollar. You only make money if somebody pays you more. That is speculation. That's not investing. Not saying it's wrong. I'm just saying, just at least know what you're doing if you're doing it.
Right. Yeah, that's a good point. Yeah, the stock market kind of dictates where gold goes.
Yeah. It's kind of the risk and reward.
Dictates where crypto goes.
Yeah.
Do you do any crypto within the holdings?
No.
So you don't mess with any stocks. So that's kind of the different. Berkshire kind of messes. I don't think he does crypto, but I think he does.
Yeah, we've used stock as a conduit to acquisition. We prefer a simple. The insurance company we bought up in 2014 took control of that. That was through the stock market. The stock market does create opportunity. The problem is you really have to check if there's poison pills, if there's opportunity to control, if there's avenues. I have no interest in being a non-controlling partner in a business.
Right.
In holdings, we have a process and we want to have the control to have it. So there is ways to acquire companies through the stock market, but it's a lot easier if we can just rip a check and have it done.
Yeah, right.
Because then you got to play the volume game, and it's just
yeah. I think we talked about that in our last episode of trying to acquire things through the stock market. It's not easy. So what are you looking to acquire? If someone's listening to this, and you're acquiring businesses always. Yeah. What are you acquiring right now?
I mean, I think our divisions are going to be, anything mobile home park related, anything Class A self-storage lots for development. Those are our biggest things right now. In 7 years, I will then be back probably on the docket looking for more operating, and those will be $250 million plus acquisitions. Yeah. WD-40 is a company I'd love to buy, all of it, but
WD-40.
Yeah, they meet all my metrics.
Oh, really?
I just love. I mean, it depends on the price. They're public.
Okay.
We'll see. That might be 7, 8, 10 years from now, but
yeah.
Those are things I'm looking for.
Yeah, I always wanted to buy the martini teas.
Oh yeah,
just because they don't break.
Yeah,
I just gotta change the formula a little bit, make them break once in a while. So then people gotta buy them once they buy it.
I like that.
I'm just kidding. But if you're listening to this, I would look at it.
I would buy it. But seriously,
I'd look at it. Well, cool, man. I appreciate you having on. Where do we find more about you?
Yeah. So AbernatheyHoldingCo.com. You can go there and you can see all of our subsidiaries and contact AndrewAbernathey.com. And then I'm on Facebook and Instagram as well. So I'm always looking to have a conversation.
You're posting stuff. He's on social media. DM him. Find out more.
Yep.
The guy's a brainiac, even though He's a C average. I'm C minus then. I appreciate you having on, dude.
Yeah, thank you.
All right.
Loved it.
See you, buddy.
Yeah, thanks.